welcome back after the break. So as we were discussing that the scenario one envisages wherein the interest rate uh, would increase by 150 basis points from at the end of the first year, just before the first coupon is received, and is likely to remain so for the next 5 years, up until the end of the next 5 years. Um, so under this circumstance, the question was that how do we enumerate the reinvestment yield and as far as the total yield is concerned. So as I've drawn the diagram for you. These are the cash flows that are being received. Now these cash flows are being reinvested. So when you reinvest this cash flow, all that you need to do is to set your calc function. CF is equal to, of course, a 0. We are talking about this period, and from this period onwards, after the cash flows are received, that is the first cash flow, and up until the next 6 periods, the F1 is 6. So if you put this and then after inputting this, simply come to second NPV function. So this is second and the cash flow function. So first we make use of this cash flow function, and once we have inputted this detail, we come to the NPV function, and the first thing that it is going to ask is to input the I by Y, that is the rate of interest annually, and then we put in here 8%. So remember, before we do this, there is one small correction. Since we are talking about reinvestment, really speaking, this 80 is now, this is CF1, this cash flow of 80 should be preceded with a minus sign. So it is CF1 is equal to minus 80, and then F1 is, as one mentioned, for how many periods? It's 6 periods. And we put this as the I by Y, and then we go on to press the CPT PV, CPT and PV. Sorry, just press the down key. Once you've done this, just press the down key, and then first it will give you the NPV option. We don't require the NPV, so press the down key again, and then you have the NFV. So when you have the NFV comes out to be something close to something close to 586.87. Once we have completed that, then from this period, that is end of the 6th period up until another period, for one more period, the interest rate becomes 8.5%. So what we need to do out here is we make use of the cash flow function once again. So we put in second cash flow function, and in this case now we put in CF0 as minus 586.87 because this is an investment that we are making, and CF1 is your 80, and we require this for one period only, because after the end of the 6 periods we're practically left with one more period. So this is 1. By default it is going to come 1, so keep it at 1, and then press second NPV calculation. So once you press second NPV calculation, it is going to ask for the input of I by Y. Put in 8.5%, and once you put in 8.5%, then press the down key. You will find the NPV first. We are not interested to find the NPV. CF1 also will be preceded with the minus sign, and then we press the down key once again. It is going to give us the NFV, and just we press, once you've got the NFV, just press CPT, and then the rest of the amount, it will get to somewhere close to 716.7586. Okay, now this was the calculator notation. Let me just briefly explain that what has happened here. So we were particularly interested about the reinvestment yield. So we received, and what we say, the assumption was that after at the first coupon being received, just before the first coupon being received, the market interest rate shoots by another 150 basis points, and the market interest rate or the yield to maturity or the yield curve now becomes 8% instead of the earlier 6.5%. Hence, this first cash flow, if we reinvest, so assuming that we are going to reinvest at the market interest rate, so we are going to reinvest this 80, the first cash flow being received for a period of 6 times, right? So once it's received, 1, 2, 3, 4, 5, and 6. It's going to be reinvested for 6 periods. Similarly, the second one is going to be reinvested for 5 years, 5 periods. The third one is going to be reinvested for 4 periods, and so on and so forth. The last cash flow, that is the sixth cash flow, it is going to be reinvested only for 1 period, and the 7th coupon obviously will not have any reinvestment whatsoever. So when we do that, so this 80 is now going to be multiplied first with 1.08 to the power this first cash flow for 5 periods, and then one more period, this first cash flow will be multiplied. So now it becomes whatever be this, and this will become 1.085. So when you do this math, so this is what the first cash flows net future value at the end of horizon for 2 different interest period for 2 different times we get, right? So this becomes our first cash flow. So similarly, the second cash flow, NFV2, is going to be again 80, but this time it is around 1.08 to the power 4, but obvious, and this gets multiplied by 1.085 to the power 1. Because all of these cash flows at this terminal period is going to be only compounded for 1 period with the new rate of interest. So if you go on all of them, so like NFV1, NFV2, so like this, if you go on, and then finally, because the 7th period really doesn't have any future value of investment, and when you do that and you add all of that, NFV plus the last coupon, that is what this 716.7586 is. So we just make use of the calc. So I hope this portion should be now amply clear with all of you. So with this, the net proceeds at the end of the investment horizon becomes 1000 as the face value plus 716.7586. We roughly keep it at 758 only. So this becomes 1716.76. We are rounding it off. So over a period of 7 years, my initial investment of 1082 with the reinvestment proceeds have finally yielded this as the absolute amount. So what is the total return? The total gross return has been, it's very easy to calculate, 1716.76 minus 1082 divided by 1082, the whole of this expressed in percentage term. So if you do this math, this comes out to be somewhere close to 58%. And if you do it on a CAGR basis, that is compounded annual general rate of return. So this return has been achieved along with the investment proceeds, it has been achieved over a period of 6 years. So simply put this future value (1 to the power 6) and deduct 1 from that, and the whole of it, take a percentage of this. So once you do this, this figure will somewhere close to be 6.75%. Okay, so along with the reinvestment proceeds, the entire proceeds have been along 6.75%. Mind you, this 6.75% is greater than the market interest rate of 6.5% initially. And why it has been so? That has been because the interest rate has gone up at the end of the first year. And with the elevated interest rate, the reinvestment proceeds is definitely more than what the market interest rate would have given. Okay, so hence this is around 25 basis point more than the market interest rate. So let's work out the second scenario. So the second scenario, it says that after issuance, the yield remains unchanged as the market interest rate remains constant throughout the life of the bond. So under this circumstance, of course, what's happening, I'm redrawing the graph for all of you, just in case the first one did not make much of a sense. I'll reattempt with the graph, hoping that you would get a better view. Okay, so this much space should be sufficient for me. We already know the cash flow schedule. These are my cash flow schedules. So with these 6.5%, which means with the market interest rate not changing whatsoever, so and the yield remaining constant, so the market reinvestment rate also remains constant at 6.5. So let's see what's happening. So the first cash flow I'm receiving here. So the first cash flow which I receive here, I invest this cash flow for a period of 6 times. Okay, and this becomes 1.065 whole to the power 6. The second cash flow which I'm receiving here, that I invest for 5 period, it is compounded for 5 period. So this becomes 1.065 whole to the power 5. The third cash flow I'm receiving here, and hence the total proceeds of this third cash flow at the rate of market interest rate of 6.5% becomes this. So along this line, if we go on doing this exercise, we will see that the sixth cash flow will yield me 1.065 whole to the power 1, and the last cash flow, of course, is not going to yield me any reinvestment proceeds because there is just no scope for investment. So when you have done all of them and then you add all of these net future value of all of them, that's what the proceeds are going to be altogether. So this proceeds are added with the face value of the bond, and this when divided by the initial price that you paid for the bond, which is 1082.27. If you divide all of that and deduct one from that, okay, and take a percentage of it, it will yield you 6.5%. And for this, I really need not do any calculation whatsoever, because I know for sure that this is the very definition of what a yield to maturity is all about. Remember, the yield to maturity talks about the cash flows being reinvested at the same rate of interest at which they were discounted. So I already know what my market interest rate is, which is 6.5%, and I'm reinvesting back to them at 6.5%. So net at the end of my investment horizon, or at the end of the tenure of the bond itself, the total proceeds cannot exceed the market interest rate of 6.5%. In fact, it will be exactly at 6.5% only, because that is the very definition of YTM. Okay. What was the third problem? The third part of the problem says that after issuance, just after the second coupon is received, the market interest rate drops by 100 basis points. So when the market interest rate drops by 100 basis point, what is going to be the reinvestment yield? So in the third case, the situation is absolutely similar, with the additional twist that it is happening after the second coupon is being received. After the second coupon is being received, the market interest rate would drop by 100 basis point, and it will remain same for the remaining of the tenor. So in this case, if we again redraw the timeline, so this is my t is equal to 0, and this is my t is equal to 7, and this is my t is equal to 5, 5th period, 6th period, 1, 2, 3, and 4. So this is my timeline of cash flow receipt. Now, as I receive my cash flow, I will be reinvesting those cash flows, right? However, there is a twist, and the twist is that the market interest rate drops at the end of the second year itself, and not before that. So from here, the market interest rate becomes 5.5%, right? Because it drops by 100 basis points. So if the market interest rate was 6.5%, if there is a drop of 100 basis point, that means from at the end of second year onwards till the tenor, till the remaining portion of the life of the bond, the market interest rate will be 5.5% only, which means that now there are a couple of inferences that we could draw from here. The first is that between the first coupon and the second coupon, after the receipt of the first coupon, the reinvestment from this portion to this portion, the reinvestment yield for this one period is going to be still at the rate of 6.5% because there has not been any change whatsoever between the period 1 and period 2. So whatever cash flows are being received at the end of the first year, they are going to be reinvested at the rate of 6.5%, but for only 1 year, only for one period. And then thereafter, the entire reinvestment up until the tenor of the bond will be capped at 5.5%. So all that we have to do is to divide this problem in two halves. The first half, of course, is when you are receiving your first cash flow, and this first cash flow you are simply compounding it for one period. So I'm not going to put my calc in a formula mode and do the job for it. It's as simple as that. So I do this math, and whatever this math comes out to be, let me just do it for you. So it comes out to be 85.2. So this is 85.2. So this is my first milestone that I have to enumerate. And the second thing is that from the second year onwards, all the cash flows, including this proceed of 85.2, they are going to be reinvested only at the rate of 5%, 5.5%. So what do I do? I again can fall back on my cash flow function in the calc, and I put this syntax of second cash flow. Once I do that, immediately the screen that will open in my Texas BI 2A Plus Professional is going to be CF0. So put in CF0 as 85.2 with a minus sign. The minus indicates that this is your net investment, which is cash outflow. That is how the calc understands. And then thereafter, press the down key. Once you press the down key, it will ask for CF1, that is the first period cash flow. Obviously, that's going to be 80 with a minus sign. And then once you press that, you will have F1, which is the frequency. The frequency obviously is going to be for the next 6 periods, right? Because at the end of the second period up until the 7th period, it's going to be all put together 6 periods. So put this as, I'm sorry, it's going to be 5 periods. They're going to be 5 periods. So put this as 5 period. So once you have inputted this detail, then press second and press Npv function in your calculator. It will immediately open up the screen wherein it will, Npv stands for obviously the net present value. So once you open that, the first syntax that is going to come is I, which is basically the interest rate. So input the interest rate as 5.5, press the down key. So once you press the down key, it will point NPV. Obviously, we are not interested in NPV, so we will ignore this and we will press the down key once again, and it will give me NFV, which is the net future value. Remember, NPV is net present value and NFV is the net future value. When we want to discount something from the future cash flow, then NPV becomes a matter of importance because we are interested to know the worth of the future investment in today's term. When we want to know what our investment would be in future, then we are interested in the NFV, or the net future value term. So once we get the NFV, just press the CPT key and then it will give you the total proceeds, and the total proceeds after this exercise is going to be 669. Okay, so your total reinvestment, so this is your reinvestment yield in absolute terms. This is your reinvestment yield in absolute terms. So the total yield is going to be your reinvestment proceeds or reinvestment yield in absolute term plus the face value, which is by default is 1000 here. So the your total yield is going to be, or proceeds or output is going to be 1669. Now, having known that this is the total, so the gross return over a period of 7 years is very easy to find out now. That is as simple as 1669 divided by 1082, which was your purchase price. So simply deduct 1 from them and take the percentage, and it will give you something close to 54.17%. And if you take the annualized return for it, so it is all that you need to do is simply compound 54.17%. Just to do this matter, 1.5417, this divided by 1 to the power 6 minus 1, and whatever it comes, just take the percentage of that. And once you do the math, this will give you a yield of 6.38%. See how this 6.38% is less than the market interest rate of 6.5%. Now, why did it so happen? It happened because a couple of things. One is that, as I've mentioned before, that if you hold on to the bond till maturity and if the issuer does not default, the only thing that you're getting out of your principal is your guaranteed face value, which is by default 1000 out here, right? This is what you're going to get. However, the interim cash flows that you had received, those interim cash flows are now being reinvested at a lower yield, at a lower market interest rate. Since the total cash flows that are being received are being reinvested at a lower market interest rate, hence the total proceeds after the investment horizon is over at the end of the tenor is obviously less than the initial rate of interest or the initial yield to maturity, because your reinvestment yield itself is less than the market interest rate. So we just exemplified in a detailed manner of the theory that we were propagating. Let's take one more example. Peter Harrogath is the bond portfolio manager at Silver Oak Capital LLC. Peter is considering a maiden issue of Maple Tree Company that is a 7% annual pay 5 years issue. The yield to maturity determined is 6%. Peter's investment horizon is 3 years. Research department at Silver Oak Capital indicated 3 interest rate prevailing at the time of sale. One is at 5%. Second is at 7%. And the third is at 9%. Assuming yield is equal to the interest rate, what is a theoretical fair price of the bond that Peter should pay? And also indicate the total yield in this investment under the 3 given scenarios. Okay. So let's again, draw a quick timeline of the problem. And as I keep on mentioning to all my students and the student candidates who are watching my program, is whenever you are, faced with fixed income related problems or derivative related problems, one very easy way to get around them, and wherein it is almost, I would say, conceptually at least, negligible chance it holds to commit any error, should you follow this practice. And that is, always draw the timeline. If you're able to explain the problem through the timeline diagram, it is extremely unlikely that you will be committing any mistakes. Of course, the calculation error is something which is not being held accountable here. So that's that. So given this timeline, let us redraw the problem here and see if we are able to make some sense out of it. So we've got a bond, and that bond makes a payment of, it is making a payment of 7 for want of the face value in absolute term. We will assume that the face value out here is 100 because nothing has been mentioned. So the 7% of 100 is 7. So it's getting an annual coupon of 7. with an annual life of a full tenor of 5 years, and the determined yield or YTM is 6%. All right. So first we draw the timeline as we have mentioned. So we have got okay. So what's happening is the bond will be making a payment of 7 here, 7 here, 7 here, 7 here, and the last 7 here along with the face value. Okay. Now with this, the investment horizon uh, of Peter is not up until the tenor of the bond. He is going to, purchase this bond at the issuance itself, and is going to hold on to it up until the next 3 years. So his investment horizon is limited to 3 years only, and not the full tenor of 5 years. So up until this is Peter's investment horizon, while the whole of the bond's life is this 5 years. Okay. Now it says we're going to divide the question as before in two parts. The first part is how much is the what is the price of this securities. So this is the first question that is being asked. What is the price of this security? So as before, we simply input all of these details that I mentioned here in our calc in order to glean out the price. And if you do that, I hope you're aware, or you're at least conversant with how the TVM problems are worked out in your calculator. If you have not, then I would sincerely request you to watch my video tutorial. There's a detailed tutorial that I have made on the use of the TIBA2 Plus Professional. So once you do this exercise in your calculator, you will find that the present value of the bond as something close to 104.212. So this is, of course, the theoretical price of the bond, which means that Peter at the max should be paying for the security at the rate of 104.212. Or if he's getting it less than that, nothing like it. All right. So this is his investment price. And then the other thing that is being talked about is that at the end of his investment horizon, the market interest rate is likely to change. Now, when it changes, there are three possibilities that have been outlined here. Those three possibilities are that the market interest rate becomes 5% or 7% or 9%. So which means that at the end of the third year, for the next 2 years, either of these, any of these three market interest rate could prevail. And depending upon that, what would be the likely what would be the likely gain investment proceeds of this whole exercise as far as Peter is concerned. Okay, so we divide this problem into two parts. First, we found out in fact, in three parts. So first, we found out the price that was being asked of us. So this is the theoretical price of the bond. The second, obviously, we will find out what are the reinvestment proceeds for the next 3 years, or for the next couple of years, in fact, because after the first coupon is received, the maximum reinvestment period is for 2 years for the first coupon and 1 year for the second coupon. So we need to find that. And the third is we will have to find out what are the different sale price that Peter could expect at the end of his tenure. So I'll start with the third part first. Third part, we have already found the present value, the theoretical price of this bond. So here what we need to understand is that at the end of the third year, really speaking, there is only a couple of more years left to this whole tenor of the bond, to which Peter obviously is not going to be party to. But nonetheless, he would like to know at what price he would be in a position he should be expecting at the end of the 3 years, depending upon where the market interest rate is likely to be. So all that we need to do is to do this TVM exercise as we have done here. Once again, under this three different assumptions of interest rate, and with only one more change in your original TVM problem. So two changes you have to make. One is with the interest rate each time of 5%, 7%, 9%. You'll have to re-input all of these details. And the second is that you have to change the n from 5 to just put in 2. Okay, so this 2 is going to remain constant, whichever interest rate you can think of. So really speaking, the interest rate is something that only we need to re-input 3 times in our calc setting. So once you do that, you will see that under the 5% interest rate regime anticipated, the market price of the bond at the end of 3 years would be 103.7188, or I will round it up to 103.7 only, 72. Under the interest rate expectation of 7%, the price of the value of the bond at the end of 3 years will be 100%. And for this, obviously, you need not do any calculation whatsoever, because here the market interest rate at the end of the 3 years for the next 2 years is exactly equal to the coupon rate. So there is just no need to do any calculation. We know it for a fact that whenever the coupon rate equals that of the yield or the market interest rate, then the issue will de facto be trading at par. So this is going to be 100. And the third is under the expectation of 9%, the market fair price of this security at the end of 3 years would be 96.48, and we round it up to 96.49 or even 96.5. Okay, so given this, now the third part of the problem is that we have to understand what are the reinvestment proceeds. So as we say that 7 is the first coupon that is being received, and it is being invested for a couple of years, and they are going to be, since there is no change of the market interest rate, so they're going to be invested at the same market interest rate, and this cash flow is going to be reinvested for one more period, the one period only. So when you do this, this comes out to be let me just do the math for you here. So this becomes 7.865, and this becomes 7.42. So if you add these two, this becomes, the total proceeds become, including the reinvestment yield, becomes 15.285. Okay. So what we have got here now, Peter, so we will simply summarize the problem now, and we will proceed towards the final answer. So first we found out the value of the theoretical fair price of the bond at the issuance itself, and that is 104.212. This is what Peter should be paying at the most as part of his investment. And at the end of his investment horizon, or holding period horizon as it is known, he can expect a total yield of 15.285 from the reinvestment proceeds of the coupon, and 3 different prices depending upon what the market interest rate would be. It is but natural that all we have to do now is to do this math. 15.285 plus, first we do 103.72 divided by 104.212. This is the yield under 5% interest rate regime. Second is 15.285 plus 100 divided by 104.212. This is your total return under the assumption of interest rate of 7%. And the third is 15.285 plus 96.49, this divided by 104.212. Okay, so your denominator is your actual investment that you had made, and your in your numerator, only one thing is changing, and that is your different expected price at the end of the investment horizon period, depending on what the investment rate, what the market interest rate would be. Now, I'm sure that the rest of the calculation you should be able to do it yourself. Only a couple of things I would add here. So if you do this exercise, whatever thing which you are getting, whatever return that you will be getting out of them, they will be over a period of 3 years. So if you have to annualize them, so the annualized would be nothing but just only take this fraction, do not convert it into percentage, whatever fraction you're getting here, take that fraction at different under different yield assumption, and that simply discounted for 3 periods. So it's to the power 1/3, and whatever it comes, deduct 1 from that and take a percentage of it. That is the CAGR under 3 different interest rate regime. So once you do that, you will be able to find out what is the absolute yield, what is the yield in terms of percentage under 3 different interest rate scenario at the end of the holding period. And now the question is that if Peter has to make a choice between the one which is going to be most profitable, but obvious where the market interest rate is least at the end of his investment horizon, that becomes the obvious choice. Okay, so obviously, given a choice, Peter would want this interest environment, because this would obviously end up with a higher ending value of his sale proceeds. Okay, having done a couple of maths there, now let's move our focus to duration and its variance. I'm sure that by now you are all aware what a duration is all about, but for the uninitiated, I would rehash this once again. The simplest definition and the most effective definition of duration is, it is actually the measure of how soon you are getting your promised cash flow. And believe me, guys, if you hold on to this simple notion of duration, I can assure you that each and every other complex mathematical formula regarding duration itself will become that much easy. Okay, so the very simple definition of duration itself is that how soon are you getting your promised cash flow? That is the measure of duration. The sooner you're getting it, lower is the duration. Lower is the duration, lower is the riskiness of the bond, all other things remaining constant. The further away you are getting your cash flows, or the worth of cash flows, higher is your duration. Higher is your duration would mean it will be more sensitive to the rate of change of interest rate in the market or the yield itself. Hence, it is a little bit more riskier. Okay, that's the very basic of definition of duration, and I want all of you to know this, and that would serve the purpose beautifully. Okay, now in our preceding chapters, I have already explained what is the meaning of modified duration and how modified duration is closely tied with the MAC duration or the Macaulay duration. Frederick Macaulay was the first Canadian person who actually revolutionized, or who first actually introduced the concept of duration as part of the measure of sensitivity of bond, or the riskiness of the bond itself. I've covered that in details in my preceding videos and did not mull it over again. So a few of the notes that I've made here, I want all of you to take note of it, and that should be more than sufficient. Modified duration is closely tied with MAC duration, which is nothing but the Macaulay duration divided by the periodic 1 plus periodic yield, which takes into account of the current situation. Modified duration takes into account the change in interest or the yield rate uniformly across the term structure. Duration is nothing but this is what the formula is. And now that we know, when this duration measure is multiplied with the absolute value of your bond, it will give you the absolute duration measured in money terms, and that is where it is called as the money duration as well. Okay, money duration, when it is done only for the change of 1 basis point movement in the market, they are also called as the price value of basis point. So a basis point, price value of basis point is, these are different notation. There is no need to be scared or intimidated with the terminologies used here. You need to get yourself accustomed to them. The PVBP, what it means is that 1 basis point is equal to 1/100th of a percentage, which in your fraction form or decimal form forms part of this. You can do the math yourself. I am not going to waste my seconds and minutes out here doing that. So all that it says is that what is the price value change for one single basis point change, and that is what it is called as the PVBP, or the price value on the price value of basis point. This is nothing but the money duration part only. It's money duration only, but where the money duration is only for a 1 basis point. Okay, because in reality money duration can be measured over a yield change of 1 basis point, 2 basis point, 25 basis point, I don't know. Okay, that's what it is. Few of the properties of duration, I am recounting them. MAC duration was originally used for zero coupon bond. However, it could be used for coupon paying bond as well. Of course, it can be. We will see in the subsequent slides how they are gleaned out mathematically, depicting the entire cash flow. For the same maturity, coupon paying bond has a lower duration than zero coupon bond because some of the promised cash flows are received earlier. Exactly what I was talking about. Macular duration is used to measure sensitivity of fixed rate bond. All other duration measures were improvised on MAC duration. Okay. Now, the other variants of duration is effective duration. What is meant by effective duration? And there is one more variant called key rate duration. And these are few duration measures that we need to understand them first before we move into the other duration spread measures. So let me directly dive into the graph. This graph should be pretty familiar to you. The ones who have already watched my videos earlier, they would be knowing what I'm talking about. But again, to the uninitiated or the ones who have recently joined my channel, let it be known that there is a reference curve in the market, and more often than not, the reference curves are basically the treasury security themselves or very high liquid security in the market, which are near or almost or actually default free securities. In absence of some of the maturities security, the swap spreads of the respective sovereigns are also taken as the reference curve or the reference benchmark. Any security which is not a default free, for example, a corporate security which is not default free, they will be having proportionate risk measures which are stackable in nature. These are those components of those risks, in starting with the credit spread or the credit risk, liquidity risk, option, modeling, maturity, business cycle, and last but not the least, the inflation spread. The abbreviation of which, or the mnemonics of which, is been called as the CLOMB. It will help you remember. So these lines which you're seeing, they are actually nothing but the part of these spread measures. And as the bond becomes riskier, these spread measures would increase. As the bond's riskiness comes down, the spread measures accordingly or proportionately will decrease. And when you add all of them, this is your final yield curve. Right. Now, the yield curve movement in the market can be attributed to one of the many factors. One, to begin with, it is directly related, of course, to the reference benchmark itself. If there is a movement to the reference benchmark, either on the plus side or on the minus, accordingly, the yield curve will also shift. Similarly, the benchmark curve remaining constant, which means there being no change with the benchmark curve across the maturity or the tenor of the security under consideration, but the stackable yield measures attributed or attributable to the spread measures, if there be an alternation or if there be a change in those spread measures, they will eventually impact this curve which sits above all of them. So this yield curve could be shocked because of this reference benchmark, as well as any or all of the interim spread measures itself. Now, one thing that we need to understand, that all of these movements that we have talked so far are parallel in nature. So which means that the reference benchmark being shocked by all other things remaining constant, the reference benchmark moves up or down by 100 basis points, the yield curve will move 100 basis points across all the maturities themselves. Similarly, if the stackable spread measures move up and down with a certain basis point, the yield curve will also concurrently move up and down, but exactly in a parallel fashion. And that is what is called as the shape preserving effect of the benchmark itself. More of this in our subsequent part of the video, where we'll be concluding the most important lesson of this portion of the chapter. Thank you.